Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. End of calendar quarters provide a good opportunity to take stock of the situation in financial markets. In this context, the first quarter of 2022 proved to be no slam dunk for investors. A range of uncertainties continue to persist through this period. To start with, potential for the growth to slow considerably during 2022 after a sharp rebound in 2021 created a growth scare. Given the extreme sharp moves in economic activity during 2020 and 2021, markets faced uncertainty around the outcome for growth in 2022. Inflation that appeared to be transitory turned out to be more persistent, at least relative to initial expectations. Near-term inflation prospects remained sticky at elevated levels, although the long-term inflation expectations remained well anchored. Pandemic-related economic and social restrictions in Asia continued to cause supply-side bottlenecks. Against this backdrop, financial market participants weighed the possibility of a stagflationary environment. Tighter monetary policy across developed markets was already on cards coming into 2022, but the first 3 months of the year saw interest rate expectations move to a hawkish extreme. As such, central banks in the US and the UK moved to raise interest rates, and the European Central Bank sounded more hawkish. This caused financial conditions to tighten at the margin. Conflict between Russia and Ukraine added to the stagflationary talk as growth expectations came down and inflation expectations increased. In fact, towards the end of the last quarter, talk of an imminent recession intensified. As a result, equities posted their weakest quarter since the pandemic began in 2020. Given the broad range of uncertainties and risks, there were few places for investors to hide. A model portfolio of 60-40 that invests 60% in equities and 40% in bonds fell for the first time in 2 years. In the US, S&P 500 and Nasdaq composite indices posted losses of 5% and 9% respectively for the quarter. US Treasury bonds have also suffered dramatic losses. The 2-year yield has risen by 158 basis points, the most since the second quarter of 1984. The benchmark 10-year Treasury yield has increased by 82 basis points, the most since the first quarter of 2021. Just as a reminder, yields and prices move in opposite directions. That is, rising yields mean falling bond prices. A Bloomberg index of total returns from Treasuries fell 5.6% in first quarter of 2022, making it the weakest quarterly performance since the inception of the index in 1973. In credit markets, US high yield index fell by circa 5% in Q1, its worst performance since the first quarter of 2020. Investment grade index is also down circa 8% in Q1, also the worst in 2 years. Commodities, however, was the only major asset class to have posted gains through the quarter. From oil to copper to wheat, the prices of basic materials have surged as a supply crunch was exacerbated by Russia's invasion of Ukraine. For the context, Bloomberg Commodity Index jumped 25%, marking its best quarter since 1990. Brent crude prices rose circa 40% during the first 3 months of the year. Aluminum prices increased 24% and gold prices rose circa 7%. Food prices rose sharply and hit a multi-decade high. Looking ahead, we stick with our view that the global economy is currently experiencing an asynchronous mid-cycle slowdown of this faster-moving cycle. Such phases in the past were usually associated with higher uncertainty and higher financial market volatility. However, as the cycle matures into a new normal, uncertainty should start to diminish and provide a reasonably clear path for financial markets. Yet, recession probabilities are worth keeping an eye on. Empirically, for equities, looking at the data since 2000, there were 8 instances when the performance of MSCI All Country World Index was negative in the first quarter of the year. Over these 8 occasions, the average drawdown was circa 7%. In 7 out of these 8 episodes, global equities posted gains during the second quarter of the year with an average return of circa 9%. The only exception was 2008, where equities lost 2% in Q2 following a 10% loss the prior quarter. This also confirms our view that in absence of a recession, the probability of which we are watching very closely, equities can stage a recovery in Q2. Our recession probability indicator RPI has risen recently, but from the lowest level in its 42-year history. Even after the recent rise, the RPI is still close to the lowest points of the previous cycles. It is worth reminding that recession probabilities tend to rise even during the mid-cycle slowdown of an economic cycle, which we did expect the global economy to experience this year. So as the rhyme goes, first is the worst, second is the best. First quarter of the year saw its worst performance since 2020. The question now is whether the second quarter will fulfill expectations. Thanks for listening. We hope you found this podcast useful. If you did, we would appreciate it if you could share it with a friend or a colleague. For more information on what was discussed on this podcast, please reach out to your ADCB relationship manager. You can also log on to our website at www.adcbam.com for more information. My name is Kishore Muktinutalapati, and I will be back next week with more global investment insights.
you.